The ATRAM Alpha Opportunity Fund Incorporated has one mission: to look for the winners of tomorrow. The fund actively finds the fastest growing Philippine companies with high quality management and sound business strategies. This growth has often translated to higher stock prices. The fund has a proven track record of selecting companies outside the Philippine Stock Exchange Index that were eventually included in major indices, while most funds in the market stay within the Philippines' top 30 companies. This has led the fund to consistently outperform the market in the long term. Furthermore, the fund invests in long-term drivers of growth that could provide significant gains for investors, such as technological advancement, tourism, infrastructure, and sustainability. Invest in the potential of the best growth stories the Philippines has to offer. Invest in the ATRAM Alpha Opportunity Fund Incorporated. For more information, visit www.atram.com.ph.
Hello and good morning, everyone. Thank you for joining this week's episode of the ATRAM webinar series. I am Belle Marquez, Portfolio Solutions Manager and your host for today. Nearly 2 years into the pandemic, the Philippine equities market needed to adapt rapidly, with responsiveness being the name of the game. This year will be about identifying opportunities to drive growth in the coming months. 2022 may perhaps be one of the Philippines' most crucial, as the country gears up for hopefully a sustained reopening story and, of course, a change in government. Stay tuned to learn more about these opportunities and how you can better position your investments in 2022 and beyond. If you have questions, you may send them as early as now by clicking on the Q&A button found below your screens. Before we begin, I'd like to let you know that this session will be recorded and that copies will be disseminated as well as posted on all our social media platforms. Also, please don't forget to visit our website, www.atram.com.ph, for a more detailed information about all the funds that we offer. If you have any friends who you think would like this webinar but are unavailable to attend, also please feel free to share the YouTube replay of this session or visit our YouTube channel, ATRAM Studio. You may also scan the QR code to visit any of our official social media pages. We'd like to also invite you to join ATRAM's official Viber community group, so that's #ATRAMPH community, to stay updated on the latest announcements, advisories, and reminders. Scan the QR code or visit the link on your screen and get a chance to win ATRAM merchandise. We'd like this webinar to be as interactive as possible, so please don't hesitate to send your questions in the Q&A tab all throughout the webinar. Each question you send is a raffle entry for a chance to win limited ATRAM merchandise. Winners will be announced at the end of the webinar, so make sure to stay until the end. We will also be wrapping up with a quick feedback survey after the webinar, so we do hope you can share your thoughts with us about our session today and how we can further improve our webinar series. So, without further ado, let me briefly introduce our speaker this morning, Mr. Carlos Navarro. Carlos is currently a portfolio manager in the ATRAM Equities team. He was previously the portfolio manager for equities in the trust banking group of the second largest local bank in the country and has 8 years of experience in the fund management industry. He also holds 2 master's degrees. The first is a master's degree in management from the University of Asia and the Pacific, and the second is a master's degree in computational finance from De La Salle University. So hello, Carlos. I'll give you the floor.
Good morning, everyone. Thanks for tuning in. We're going to discuss with you our market outlook for this year. I hope you learn a lot from our presentation today. So for this slide, we're going to present to you our base case, our bull case, and our bear case. So for our base case, we are targeting 8,600 for year-end 2022. Now that is based on a price-to-earnings ratio of 19.5 times, and that is the average PE or price-to-earnings ratio for the past 10 years, going back to the pre-pandemic levels. And the next is it is also premised on a 43% earnings growth. Now that is our base case, and for bull case, we are targeting 9,400. Now, we adopt a higher price to earnings ratio here at 21.2 times, although we maintain the same earnings growth at 43%. Now, the reason that we increase the price to earnings ratio at 21.2 times is the assumption here is that foreign funds will come in a big way for this year. So we got the average price to earnings ratio in 2014 and 2017. And those are the years which we received over $1 billion in terms of net foreign inflows. And when we average the PEs, it comes out at 21.2 times. And that is how we got that price to earnings multiple. And when we use that and adopt the 43% earnings growth, which is the same as our base case, then we arrive at the target of 9,400. Now, going to our bear case is 7,200. Now, that is premised on a lower PE of 17.1 times and a lower earnings growth of 33%. Now, the reason why we lowered the earnings is because the assumption here is that we will be in alert level 3 for one whole quarter. We have been in alert level 3 already for 2 to 3 weeks just because of the Omicron surge. So, but this assumes one whole quarter of being in alert level 3. That's why the earnings growth, according to our analysis, will go down from 43 to 33%. And because of the lower earnings growth, we also adjust the price to earnings ratio, the multiple that we apply to the market, at 17.1 times. And with that, we arrived at a bear case scenario of 7,200. So just a quick recap, our base case is 8,600, our bull case is 9,400, and our bear case is 7,200. So here in the second slide, we're showing you the ATRAM COVID situation indicator. And this is a slide that we really like to use for the past several presentations because this is a slide that summarizes mobility, healthcare capacity, mortality, vaccination, etc. So this is one of our favorite slides because it combines all of those factors and just puts it in one clean chart. So here, the higher the figure, the better. So as we can see here, in the early part of January, the index went to a low of around negative 0.2. And although this is higher than what we have seen in the Delta variant, this is still a big drop from the all-time highs of 1.5 that we have seen in the latter part of December. So the good thing about this is the index has bounced pretty quickly. So this is really the sharp rise and fall of Omicron, which is what we have seen also in other countries, that cases spike really fast, but cases go down really fast as well. So it's a sharp rise and fall. So this is what we saw in our country, and this is what we have also seen in other countries. And the good thing about this is, as we can see, we're back at our all-time highs in terms of this index. And that's mainly because of healthcare capacity remained manageable all throughout, which is, of course, what we have seen also in other countries. Healthcare capacity remained manageable. There's less severe symptoms, which is, of course, what we want. So, for example, healthcare capacity averaged at the peak of Omicron, averaged around a little over 60%. But this is a lot better compared to the Delta variant, where we reach critical levels already in terms of healthcare capacity. So this is actually what we have seen also in other countries. So safe to say, it's probably, well, knock on wood, it's probably safe to say that the Omicron variant is now behind us. Here, we are showing you the earnings projections for 2022. Let's first focus on the third column, the third column entitled Contribution to 2022 Growth. So here in 2022, we can see that the top two earnings contributors are the property sector and the conglomerate sector. When we combine those two, it accounts for a little over 30% of the 43% earnings growth that we are seeing for 2022. Now, let's discuss each of those sectors. First, for the property sector. Now, the reason why we're expecting a 12.3 earnings contribution to the 43% earnings growth that we're expecting this year, it's twofold. Now, the first one is the residential segment. Operating capacities right now are around 80 to 90%, and we expect the construction capacities to reach 100% later on in this year. So this is for the residential segment, and that simply means when you launch condominiums or houses or what have you. So of course, we want construction capacities to be at the very least 100%. So as construction capacities improve, we also expect the demand for these project launches to improve in line with our expected economic recovery. And the second leg of the property sector will be the malls. The malls, I think, probably is the most obvious, as we have seen in the latter part of November and early December last year, that malls were really jam-packed, to the point that some malls even reached pre-pandemic levels already, and some have even exceeded pre-pandemic levels for some select malls. So this is what we expect to see moving forward as quarantine restrictions are eased further. And this is actually very timely because we are already in alert level 1 as of March 1. So we're hoping to see this kind of foot traffic as we saw in the latter part of November and early December. So of course, higher foot traffic means higher tenant sales, and higher tenant sales means an increase in mall revenues. So those are the two legs for the property sector. Now we go to the conglomerate sector. For the conglomerate sector, the two main drivers of conglomerates on average are the property sector and the banking sector. We have already discussed the property sector, so we'll now go to the second driver of conglomerates' earnings, which is the banking sector. For the banking sector, we see three things here. First, an increase in interest rates. This will benefit the banks, and we expect an interest rate to come in probably in the second half of 2022. Of course, the banking sector is probably one of the few industries, if not the only industry, to benefit from rising interest rates, because this will also increase the lending rates of the banks. If lending rates increase, of course, their net interest margins, or what we call NIMs, increase. And when that happens, you see the earnings of banks also increase. So that's the first one. The second one are the provisions. Provisions simply mean the money set aside by the banks for its bad debts. And we see a significant reduction in provisions for this year as the economy improves further. And the third leg will be loans. Of course, this is the core operations of the banks, the loans. So we expect loan growth to average around 8 to 12% for this year. That is the loan growth that we are seeing. And of course, we see this loan growth to be a big improvement for what we saw in 2021. Because in 2021, loan growth was just about relatively flat. But now in 2022, we are now seeing an 8 to 12% loan growth as the economy reopens further, as companies go back to their pre-pandemic operation levels, so they're going to need more loans. And when the economy improves further, we can expect the consumer loans and the SMEs also to enter the fray, therefore increasing the loan growth to the 8 to 12% that we are expecting for 2022. So that's the reason for the conglomerate. So just to summarize all of this, the property sector and the conglomerate sector, if we take these two together, they already account for 30% of the 43% earnings growth that we are seeing for this year. Now here in the next slide, we're going to discuss with you the election effect. So just to give you some more color, this doesn't mean that what happens in the past will be a good predictor for the future, but the point of this slide is just to give you more color historically on what happens during presidential election years. And this is what we have seen. So here in this slide, we go back to 1992 until the latest election year of 2016. And we take a look at what happens to the stock market during those election years. So let's first focus on the left slide. On the left slide, we are just showing you the hit ratio, or simply how many times the market went up or down E+6 and E+12. When we say E+6, that simply means 6 months after the elections, and E+12 simply means 12 months after the elections. So if you look at E+6 and E+12, you can see that the market has always been up, with the exception of 1998, because 1998 was the time of the Asian financial crisis. But if we take that out, we can see that the market has always been up 6 months and 12 months after the elections. That's E+6 and E+12. Now, if we look at the right side of the slide, the right chart, this will show you the average gains of the market. Again, under E+6, let's focus on that, and under E+12, because we want to know what happens after the elections. So under E+6, we can see that the market will have an average gain of about 5%. And even more impressive is 12 months after the elections. If you look at the column under E+12, the average gain of the market is pretty impressive at 21%. So I guess the message of this slide really is that we always see a post-election rally, a pretty strong post-election rally. And there may be a lot of reasons to explain this, such as there's uncertainty on who will become the next president before the elections. But once the president, once there is a newly elected president, we're already seeing some certainty. We already know it, his or her programs. We know we have now more certainty about his, about how he or she will be running his administration. So there's more certainty in the market, and of course, stock markets in general do like certainty. They like it to be more predictable, and that's probably the reason why we're seeing this post-election rally. Now, here in the next slide, we're showing you the ASEAN consensus earnings outlook. Now, this is different from ATRAM's own earnings outlook, because we're just getting the Bloomberg consensus of the earnings growth for 2022 for the various ASEAN countries. Now, we'd like to point this out also because since 2018, we have been on a net foreign selling basis. So from 2018 to 2021, that's 4 straight years of net foreign selling. So it begs the question, when will the foreign funds come back? And this is one of the indicators, or one of the factors that they consider if they're going to come back to the Philippines or not. It's our earnings growth. So we can see here that in the ASEAN region, the top earnings growth will come from Vietnam at 22.7%. But the good thing about this is that we are actually in second place. So that's actually pretty good. Our earnings growth for 2022, the consensus earnings growth is 19.2%. So we're in second place. So rounding out the list, we have Thailand at 14.6%, Singapore at 13.7%, Indonesia at 11.3%, and at last place, we have Malaysia at 7.4%. So this is a good indicator for us. This is a good start, considering that we were laggards last year in terms of stock market performance. And we are hoping that with us having the second highest earnings growth this year, that will help our case in terms of the eyes of the foreign funds. Now, in the next slide, we're going to show you the foreign ownership levels going back to 2012. As we can see on the left, as I mentioned earlier, we have been on a net foreign selling basis from 2018 to 2021. And that's also partly the reason why foreign ownership levels, as can be seen on the left chart, are at decade lows already. So if you can see here, back in 2013, we hit we hit a high of almost 32% in terms of foreign ownership levels. But we are now only down to 26.6%. Now, those are near decade lows already. And although the good thing about this is though that we have recovered recently already. The low that we hit in the third quarter of 2021 was 24.7%, but we have recovered. We are currently now at 26.6%. So not a big recovery, but it is still a recovery. And to note also that year to date, as of last Thursday, we have received net foreign inflows already to the tune of $80 million. So it's a good start for us. And another thing that we want to point out is if we look at the chart on the right, we can see, if we look at the blue shaded region on the chart on the right, we can see that foreign funds are on average 40% underweight the Philippines. Now, that's the reason why we're saying that there's really not much left to sell. There's only a limited number of shares. There's only so much shares that you can sell, given that you are massively underweight already the Philippines. So that's the status right now of the foreign funds weight on the Philippines. So they're just waiting for a catalyst to return. And hopefully, given that we were laggards last year, given that we have one of the highest or the second highest earnings growth for this year, and the strong post-election rally that we expect to see, we are hoping that the foreign funds will continue to come back to the Philippines, just like what we have seen already in the early portion of this year. Now we go to our picks. On the upper left, we are showing you our sector picks. So our top picks are for the sectors shown in the upper left are the property sector and the banking sector. Now, the reasons for that is they are the perfect proxies for the reopening theme. We like the big caps in these sectors. They are cyclicals and they have their own individual merits. So when we say that they have their own individual merits, that simply means we have fundamental reasons in liking these sectors, as what we have discussed a while ago in the earnings growth slide. So just to give you a quick recap for the property sector, for the banks, the residential sector, construction capacities of around 80 to 90% currently, but we expect this to be 100% later on. And this will be accompanied by an increased demand for these projects, therefore increasing the earnings of these property companies. And the second leg are the malls. Higher foot traffic, higher tenant sales will lead to higher revenues for the malls. So the next will be the banks. Again, just to give you a quick recap, we expect interest rates to rise in the second half of this year. Of course, that will benefit the banks because that will increase their lending rates and therefore increase their net interest margins. We also have a loan growth of 8 to 12%. That's our projections. And also the provisions, which we expect to significantly decrease this year because there is less need for banks to set aside money for its bad debts given the continued economic recovery and the stronger reopening theme that we are expecting this year compared to last year. And our top picks for those sectors, for the banks, we like BPI and BDO. For property, we like ALI and RLC. We also like SM Prime, by the way, so it should also be here. So that's ALI, RLC, and SM Prime. For the conglomerates, we like AC. AC, in fact, is actually our top pick among all of the top picks that are shown in this slide. And for the consumer, to round it out, we have JFC, CNPF, DNL. Again, the consumer sector, another sector which we expect to benefit given that it is also a proxy to the reopening theme. And for transportation, we have ICT and SEB. So now we'd like to invite you to invest in ATRAM's funds and take this opportunity for any corrections, for if every time the index goes down, I think this would be an opportune time to add to your ATRAM funds. Thank you very much for listening in. We hope you learned a lot, and I would now be more than happy to take in your questions.
Thank you, Carlos. Well, jumping off from where you left off, I do agree ATRAM has a wide range of investment products, and our capabilities span across several asset classes meant to service the different investment objectives of each individual. And with these, it's actually with great pride that we announce that ATRAM has recently won the Best Investment Solutions Provider Philippines from International Business Magazine Award. For today's session, we hope to have assisted you somehow to hashtag Take On Tomorrow by investing your hard-earned money with an award-winning fund house. So at this point, would like to move on to the live questions from our audience. Carlos, there's a lot, but you had a very good presentation covering quite a wide area that we're in a position to have the runway to move up. We're due and ripe for that foreign investments flows. You even gave industries and names that we like, not only for the near term, but really over the long term. And lastly, the elections, an analysis in view of where the PSAI was heading or has headed in the past. So lots of questions here, pretty common. There's some common themes, but let's address first the elephant in the room because it's happening far, 1,000 miles away from us. The Russia and Ukraine tension, we can't maybe forgo to acknowledge that that's happening. So do you foresee the Russia-Ukraine tension to have effects on the local markets as it has shown, right, for other markets in the EU and US?
Yeah, hi. Thanks for the question. Yeah, definitely. I think it will have an effect on our markets. We have actually seen the effects of those tensions already in our markets. Every time the tensions increase, we can see that our market actually goes down, but not with the same magnitude as, for example, in the developed markets, for example, in the US or in Europe, where they are more directly affected. But we have seen the risk of stance already. So those are the two legs of the effect of that would be number one, the risk of stance. So those are the market-related, that's the market-related effect where investors sell their risky assets in favor of safer haven assets, for example, such as US Treasuries. So we have seen that effect. The market has corrected on that. And the second leg of that effect would be fundamentally the rise of commodity prices, which I think is more pronounced, which is more important rather than the market-related effects. Now, the reason for that is, for example, Russia, they account for about 10% of global oil. They account for 41% of European gas imports. They're a critical supplier of nitrogen fertilizers, nickel, aluminum, palladium, and what have you. And of course, Ukraine is also a critical supplier of other commodities. So these tensions would definitely cause an increase in the commodity prices, which we are already seeing right now, with oil going above $100 per barrel. So that's definitely gonna have an effect on us, and that's something that we're keeping our eye on.
Yes, that's a good point, Carlos. I just went for gas a few days ago. I was surprised. I'm quite worried if it crosses the 100 pesos a liter. I'd be quite concerned. But yeah, of course, global markets are always affect local markets, but to what extent is always the question. So, but in relation to that, I saw a question. So, given our view, right, that we've seen global markets take more of the hit so far than we have in terms of extent. So, would you go for local or global stocks?
I think to answer this question, we have to frame it to what happened to the Philippines last year. The Philippines last year, it's one of the laggard markets last year, not only in terms of the currency, but in terms of our markets as well. So for this year, we think there's more upside because for the developed markets last year, they went to all-time highs already last year. But for us, we remained pretty weak last year. Now, because we were laggards last year, we have a greater upside this year, given that we are just starting the reopening thing now with alert level 1 status as of March. So there's a lot more leg room because we have been delayed when it comes to the reopening theme compared to the other countries. So we're just starting this year. So there's a lot more opportunity, I think, in the local market rather than the global markets because we haven't achieved the run up yet in our stock market. The developed markets already have. US reached all-time highs last year. So have India, Europe, and other markets. But us, we haven't done that. For us to reach our all-time highs, we have to go to 9,000, which is really far away from where we are now. So I think there's a lot more upside given what I mentioned a while ago. The reopening theme, the high earnings growth, the foreign ownership levels near decade lows. So I think there's more upside in the local markets right now compared to the global markets.
Yeah, so all the numbers directing us to say that Philippines is poised to at least take advantage of more of the growth prospects.
Yeah. By the way, before we move on to the next question, and also in terms of the resiliency, even with the Russia-Ukraine tensions, we have been more resilient. And despite the Russia-Ukraine tensions, we have been receiving net foreign inflows to our market despite that. So again, just want to point out that we have been more resilient to these corrections. Yeah, just want to point that out.
Yeah, that's a good point. Actually, if people divest from more risky markets, where do they go? So hopefully they come to the Philippines, right? So that's our wish. Just a second question here. It's again a common theme among our audience queries. So it is actually a predicament I understand myself. So given the vast universe of stocks and equity strategies in the market, which industries do you think would be a good play? Given all what we said about the current environment, would you say growth or more value, small, mid-cap, blue chip?
I think what we're seeing now are the cyclical big caps are outperforming the market. For the small caps and the mid caps, they have been underperforming. In fact, they have been on a net foreign selling basis for the small cap and mid cap as foreign funds, not only domestic funds, but foreign funds as well, shift from the small cap to the mid cap, which were last year's winners, to the big cap names, to the cyclical big cap names this year. And that's what we have seen. If you look at the outperformers for this year, it's really a list of the big cap cyclical names. So I think for now, in the short term, I think what will outperform are the big cap cyclical names. And then when we get closer to their fair values, near their target prices already, then that's probably around when we go to the 7,700, 7,800 levels. Then I think that's the time that we can see some upside already in the small cap, in the mid caps. But for now, I think the big caps and the big cap cyclical names are really the way to go, given that the reopening theme is much clearer. The effect is much clearer on the big cap cyclical names rather than the small cap and mid cap names. But again, it's just a matter of timing. When we're nearing their fair values already or their target prices, I think that's the time where investors will shift from the big caps to the small caps.
Big cap to small cap, but timing is key.
Yes, so yes, exactly. Well said.
Yeah, and you mentioned actually a few sectors also in the presentation and during our discussion just now. Industries that will likely do well, right, given current market conditions. There's a lot of question on energy, commodities, and the oil sectors here. So, but for the benefit of everyone, let's just recap which sectors you said a while ago will look to benefit from the reopening story and given higher than normal inflation. And is oil and gas commodities one of them?
Yeah. So for the reopening theme, I mentioned a while ago the banking and the property sector. Those are perfect reopening proxies. These are cyclical names. The big caps have been outperforming in those sectors. For example, for the property, we have Ayala Land and SM Prime. For the banks, we have the big three, BPI, BDO, and Metrobank. So those are the sectors, I think, which will benefit from the reopening theme. Now, for the mining sector, yes, they will benefit because of higher commodity prices. So I think tactically, that would probably be a good play in the short term, especially as tensions between the Russian invasion of Ukraine intensifies. We can see that the supply chain would really be affected, and that's why we have seen higher commodity prices. And yes, so to answer your question, tactically, I think mining would be good. nickel prices would go higher, gold prices would go higher, given higher commodity prices. So yeah, in the short term, yeah, just be prepared to take profits when the Russia-Ukraine tensions seem to be easing already. Let's not fall in love with their stocks, but in the short term, yes, I see some upside in those stocks. For example, oil, nickel, gold. There's some upside there. But for the energy sector, I think it's a net negative for the energy sector because we can't pass on the higher input costs to the customers because of the latest CSP back in 2019. So power companies cannot fully pass on these higher input costs to their customers. So I think it's a net negative for the energy sector, but I think it's a net positive for the mining sector.
Okay. Quite a lot of tips there. So banking, property over the long term, given where things are good calls. Mining, commodities, oil, tactically, historically, they've been volatile, but it's a good play for the short term. And then energy, we're looking at it at net effect negative. So, so that's to summarize. You also discussed this a while ago, but again, lots of queries on this. And for it's been a popular topic, but let's address it in relation to markets, right? The elections. So what would be the general effect of elections on stock markets?
Yeah, as we have seen, there's a lot of volatility before the elections happen. I think that's what we have seen if we go back to 1992 to 2016. So those are 5 data points. There's a lot of volatility pre-elections, but we see a strong post-election rally 6 months and 12 months after the elections. So the stronger post-election rally we have seen would be 12 months after the elections, where the average gains are actually 21%. So that's what usually happens. Now, just a caveat. This doesn't mean that, of course, the past will necessarily predict the future, but it's a good indicator on what usually happens because there's more certainty already in the market. So I think regardless of who wins in the elections, as long as it's peaceful, as long as there are no major issues surrounding the presidency, and the most important thing is, as long as the economic programs that they have set are pretty clear, then we could see the same upside again for the stock market. So we've seen a strong post-election rally. And hopefully, of course, hopefully, the past doesn't necessarily predict the future, but hopefully we're going to see that again for this year.
Yeah, I understand that where we see some sort of minor consolidation towards election because people are waiting and see. I mean, I'm an investor myself, so that's also my view, right? So I'm trying to see who wins, and then eventually, again, if it's peaceful, the projects seem to be at play, or they hire the right, or they appoint the right cabinets, right?
Yes,
so it gives you more comfort. So yes, there to answer that election question that we've been having. Next question. We mentioned about how we're ripe for foreign investments already and how we've been quite in the net outflow in the last few years, right? So what drivers do we see so that foreign funds will come back?
Yeah, I think there are 3. The first one, we've seen foreign ownership levels at decade lows already. So there's less downside risk to the market there. There's only so much that they could sell, so there's more upside risk, especially that we've seen some pretty good net foreign inflows already year to date. As of last week, I think the foreign inflows amounted to around $80 million already, and this despite the Russia-Ukraine tension. So we have seen that already. So the upside risk is much greater when it comes to foreign ownership levels. There's only much that they could actually sell. So, and we're near a decade lows already. So I think there's more upside risk rather than downside risk. The second, of course, would be the elections. I think if the leading candidate would be much clearer on their economic platforms, then that could possibly be a boost. But it's too early to say. We're just in March. We haven't seen the surveys yet. The last time we saw a survey was back in January. So we have to see the latest surveys yet. But so far, we have seen some economic platforms already from some of the candidates. So with this post-election rally, that could be a possible catalyst. And the other thing would be the earnings growth. As we have seen a while ago in the slide that I presented, that we have the second highest earnings growth in the ASEAN region, second only to Vietnam. So that's again one of the major factors that foreign investors look at. And lastly, this is actually the fourth one. Yeah, so lastly, I think there's really a lot of upside because the rate opening theme is much stronger right now in our country compared to other countries because they already had their opening theme last year. For us, we're still going through that process just this year. So the reopening theme, given the fact that we were laggards last year, would just give more upside to our market. And hopefully with foreign investors, foreign ownership levels near at decade lows, we hope that they will take notice of those factors that I have mentioned and continue to come back as what we have seen already year to date.
Okay, very good point. So 4 points there. First, we are seeing trending upward for inflows, though slowly, but that's a good indication. Secondly, elections, hopefully it goes as peaceful as we pray. Third, fundamentals, we're again, I can't repeat the word enough, we're ripe for it. And then fourth, a reopening play, alert one came much sooner. So hopefully that signals good, at least good points for the foreigners to come back. So there, and I think I have last 2 questions, Carlos. Do you
Sure.
think Philippine markets can decouple and still go up even if US market goes down?
Not fully. We have seen a decoupling from the US markets in a way that we have seen our market less affected. We have been more resilient rather than our European and US counterparts. So I don't think we will fully decouple, but we have partially decoupled somewhat because we have our own merits for our market to go up. And that's why we are still up year to date, despite the Russia-Ukraine tension. So I think we have partially decoupled from the US and European markets, given the resiliency in the markets and given our own catalysts. So, but I don't think we would be able to decouple fully. But I don't think that the US would, go down. If the US goes down, for example, 20% or more, then that would definitely drag us. But given that there's just a slight correction in the US, I think it's safe to say that we can definitely decouple from their performance if it's just on for example, a 10% correction mode. I think that's small enough for us to be able to bear the brunt of the selling.
Some connection there, but we have a unique catalyst that hopefully will prep us for a bit of decoupling, even if they consolidate by a bit. So last question here, Carlos, and maybe a good way to end the Q&A. Which funds or which ATRAM fund would you recommend for our audience to invest in?
Yeah, we have different ATRAM funds. And it really depends on what the investors want. The characteristics are different. For example, for the equity funds, we have the Alpha Opportunity Fund, which is invested in small and mid cap names. We have the Equity Opportunity Fund and the Strategic Growth Fund, which are more skewed towards the big cap names. So I guess it really depends on what the investor's objective is. But definitely these 3 funds, they have proven good track records. So depending on the objectives of the investors, I think overall these 3 funds could be good investment instruments for everyone.
Alpha Op, Equity Op, and Strategic Growth.
Strategic Growth, yes.
Good to know. Thank you so much, Carlos. I think that's the time we all have for questions. And again, thank you as well to our audience. We appreciate you taking the time today to join us. We hope we're able to answer your questions, give you some insights and key takeaways from today's webinar. Now, did you know that for as low as 1,000 pesos, you can jumpstart your investment journey, perhaps investing in any of those equity funds mentioned? Here's how you can invest in ATRAM funds.
Hello. To open an account with ATRAM, just visit our website at www.atram.com.ph. Here, You can learn more about all the funds and services that we offer. Our site will then guide you to our online investment platform, Seedbox, where you can start investing for just 1,000 pesos. But if you have more questions, visit the website's Frequently Asked Questions page or ATRAM Academy page. Thank you.
There you go. If you have further questions or would like to learn more about ATRAM's products, please visit our website, www.atram.com.ph. Women can face unique challenges when it comes to managing their finances and planning for their financial security, being a woman myself. So in celebration of International Women's Day next week, we bring you a very special webinar by ATRAM's Head of Wealth, Ms. Marcy Cochet-Chua. The webinar will tackle some of the issues women encounter and how women can be best prepared for whatever lies ahead in their financial future. In case you've not registered yet, you may do so by scanning the QR code, or you may also type in the link flashed on your screen. Again, if you have any friends who you think would like this webinar but just are unavailable to attend today, please feel free to share the YouTube replay of this session. You may also visit our YouTube channel, ATRAM Studio, through scanning the QR code, and also visit any of our social media pages. We'd also like to invite you again to our ATRAM's official Viber community group, so that's #ATRAMPH community, to stay updated on the latest announcements, advisories, and reminders. Again, just scan the QR code or visit the link found on your screen. Lastly, before we end, please answer the survey of this webinar because we'd like to know your thoughts on today's topic. And on behalf of everyone at ATRAM, thank you again for your attendance and participation. We wish you and your loved ones continued good health and safety, and have a great day.